Welcome to another Super Macro podcast. My name is Elvis. Sitting opposite me is veteran hedge fund manager Jonny Matthews.
Hi, Elvis.
Hi, Jonny. Jonny, a couple of things I want to discuss with you today. First of all, the Fed's reaction to the non-farm payroll data and inflation likely to go above 4% as headline CPI. And second of all, the equity market's reaction on Friday after the payroll figures where it dropped 2.5%. Are we in a bear market or is this potentially forming a buying opportunity?
Great. Okay. Well, there's plenty to discuss there. Where do you want to start?
Let's start with the Fed. You know, that's I think that's it's important. When is the next meeting? It's
I think it's the 16th of this month. 16th,
okay, so it's
17th.
coming up and coming. Warsh's first
it's
meeting
next week anyway.
Tell us what you're seeing there.
Well, I think, first of all, the Fed wouldn't react to any individual payroll print, just 1 month's payroll print. But this is different. This is the third month in a row that we've had north of 100,000 jobs created.
Glad you reminded me. Well done.
Yeah.
You know, you've telling us that the payroll prints are going to be good. You've been predicting that for the last couple of months, and you've been short of Treasuries as well. Again, double well done.
Yeah, thank you. Well, that was the whole point. I think the market certainly wasn't expecting another strong payroll print. But to me, all the high frequency data that I look at, whether it's the weekly jobless claims, the continuing claims, ADP's series of weekly private sector payroll gains. And if you look at chart number one, and I've shown this a few times before, it doesn't have a long history, their weekly data, but it correctly captured the softness during the summer of last year, and it's been strengthening ever since. So we've now had 3 consecutive months of north of 100,000 payroll gains. In fact, this last Friday's payroll gain exceeded every estimate in the Bloomberg survey.
Is this largely about CapEx, you know, and the build out of AI and the increased
demand for that?
Employment?
Well, I'll come on to that.
Because the rest of the world doesn't seem to be doing that well, and the US seems to be doing fine.
No, I agree. And that is a point. I'm going to go into some detail a bit later, but I do just want to make the point that private sector payrolls have grown at an average rate of 166,000 a month over the last 3 months. Now, I think it was about 9 months ago, the Fed did a survey, and based on the fact that net migration to the States has dropped to about 0, and there's a cohort of aging baby boomers who are retiring with fantastic, fabulous wealth gains from their equity portfolio. And,
are you describing yourself on that one, though, John? Anyway, okay, sorry.
So the supply of labour has declined a great deal, and they estimate that a break-even payroll gain to keep the unemployment rate stable is somewhere between 0 and 50,000. This is the Fed's own internal estimates.
So would you describe the latest set of figures as pretty red hot then?
Yeah, I mean, I would say we do have exceptionally strong job growth. Now, people will always look at any set of data and pick holes in it. You can always cherry pick the bits to support your case.
It was easier this time to cherry pick the bits of good bits because there's plenty of them.
Yes, absolutely. In terms of the job gains were very broadly based. So up to now, we've seen healthcare driving most of the job gains.
Yes. Yeah.
This time it was leisure and hospitality.
Yeah.
Something like 70,000 in that sector.
That's a cyclical industry.
Absolutely, it's a cyclical industry. Healthcare adds 35,000 a month, almost come rain or shine. It has done for the last couple of years or so. And you could describe that as non-cyclical.
People like us are getting older and need more help.
That's very true. So the bottom line is, as far as the labour market is concerned, the Fed doesn't really have any pressing need to ease policy. And we do know that inflation is almost certainly going to be print higher at the CPI, which is due on Wednesday. Yeah. Just for the record, this is being recorded on Monday evening, so we may not get it ready till Wednesday, but the CPI print will be firmer.
Is this going to present a problem for Warsh, who's obviously convinced Trump that he can maybe at worst hold rates the same and hopefully bring them down. Is this going to present a problem for him? He's obviously canvassed himself in some way to Trump to get the job. How does he like connect the dots now?
Well, he's said a lot of things that I think he's going to struggle to implement. First of all, you're right. I think it's going to be very tough to convince the rest of the FOMC committee that there's any need for policy easing.
Or the easing bias.
The dogs let one rip. I'm gagging here. We need the air conditioning on.
Okay, no, I hear you, but...
Well, let's put it this way. He said he expects AI to help drive productivity gains,
right,
which will help lower the inflation rate. And he's also said perhaps we should look at alternative measures of inflation, like
the ones that are lower. yeah.
Like the Dallas Fed.
Strip out everything and it's zero. Okay, so that's good inflation.
Well, there is this Dallas Fed trimmed mean version of inflation where you
wrote about that in the note. Yeah.
So you take out the outliers in any month, the biggest price,
the highest
moves.
Volatility, but volatility of the individual ones taken out, and they leave you with the stuff that moves in a sort of same direction each time.
The Cleveland Fed have a similar thing where you take out the 16, I think it's the top 16% of the biggest moves, and the 16%. The most negative moves in any month.
But how does that work? If for instance, it's gasoline this month that's gone up by, let's put a number, 8%, 9%, whatever it is.
Yeah.
And we're taking that out because it's the top three or the bottom three. We're taking it out, but it's what people spend.
Well, absolutely. But look, I mean, we do tend to focus on core inflation anyway, because most people accept that, okay, there's not much the Fed can do about oil prices. So we take out food. Typically, we take out food and gasoline, and we look at core inflation, which is ex food and energy, to get a better understanding of the underlying pace of inflation. But, and I show this on chart 3. In 2022, this Dallas Fed measure of trimmed mean PCE inflation was still 2-point-something%. While the core rate of CPI inflation was already above 4%, and headline was on its way.
It's too slow moving, isn't it?
Well, yes, it is. It's too slow, and it mutes too many of the big outlying moves.
It's a perfect measure for someone like Warsh coming in, looking for an excuse to hold rates or even drop them when he can.
Yes, but I don't think the public's going to buy it, and I think
the rest of the Fed maybe.
Or the investment community at large. I mean, if you just if the Fed was to say, right, we're just going to target some kind of trimmed mean measure of inflation,
$1
and Treasuries, I would think.
Yeah.
And if you look just more recently, you can see core CPI has started heading higher. So we are getting some pass through of the energy impact. And I think, anyway, it never really got down towards 2%. It got close, but didn't get down to 2% anyway. There's been this firmer underlying base of inflationary pressure since the pandemic.
And that brings me to something you wrote in the notes. You said the May IEA report noted that global oil inventories dropped by around 250 million barrels across March and April, leaving the stocks at their lowest in over 2 decades. A signal that wherever prices go from here, they're likely to fall far. And that sort of is in tune with what you've just been, essentially what you've been saying.
Well, my big concern is the core. I think at some point, hopefully, we'll get through this energy crisis, one way or another.
But we're not resetting back down to $50 a barrel oil.
No. But that said, let's say if oil were to stay at wherever it is, let's say it stays at $100 a barrel for the next year. In a year's time, once you lap the big price increases, it's not having an inflationary impact.
Yeah, it has one inflationary impact, not more.
It's a one-off price change.
Yeah.
But I think as far as the market is concerned, if you look at the December, the deferred contracts in oil, they're staying elevated. When the front month futures have come down, the deferred months are still quite elevated. The market can't see that even if we reopen the Strait of Hormuz one way or another, that we're going to suddenly get oil back flowing freely on tap throughout the world.
So has the US got a magic force field that it's not being affected by this because everything seems to be flying there?
Well, you've got to understand the US economy does have some very pro-cyclical forces that are keeping growth extremely strong in the face of this jump in oil.
Wealth creation?
It's not just wealth creation. First of all, the tax refunds this year were quite a bit higher than
big,
previously.
Beautiful bill.
Under the One Big Beautiful Bill Act, consumers got something like 50 billion of additional tax refunds this year, which is more than enough to compensate them for a few months of higher gas prices.
Yeah.
But I think more importantly than that, if you look at chart 4, and this is the spending. This is the scale of spending. This is I've shown this chart before. This is updated. This is courtesy of Morgan Stanley Research, and you can see the 5 companies that are doing the big spending on data centers and AI. Between them, they're going to spend somewhere between 600 and 800 billion dollars this year, and just to get that into context, that is something like 2% of GDP.
Yeah, probably a bit more than 2%, isn't it? Yeah, 28 trillion and then 60. Yeah,
so that has a very strong positive economic impact. Part of that spending will leak abroad because a lot of the electronic components, the chips and the electronic switchgear, comes from abroad. So so net trade becomes a drag on GDP growth. And we saw that in Q1. Net trade, I think, shaved something like 1.25 percentage points from GDP growth in Q1 because all this equipment is being brought in from abroad. But investment spending was very, very strong and made up, I think, the strongest contribution to GDP overall.
Will that dissipate to a certain extent over the next few years with Trump's move to bring manufacturing home in any way he can?
I think it's going to make a marginal difference. But the point is,
over a long time, maybe very long time, yeah.
I mean, the point of this spending is the companies that are spending the money may or may not earn a realistic return from it. We don't know. But one man's spending is another man's income. And so this spending is going into the economy, is helping boost jobs in construction, and in the industrial sector with the suppliers of equipment for air conditioning, for electricity generation and storage, and so on.
So there's a lot of winners on the peripheral. There's going to be there's going to be a loser somewhere. One of the big ones is going to lose.
Well, we can't guarantee that all these companies are going to make
$1 trillion next year. They're going to spend
possibly. They won't necessarily all make a realistic return on their investments, but the money that's being spent is going into the economy and is supporting economic growth. And so as far as the stock market is concerned...
interesting.
What we've seen, I mean, we've seen obviously explosive, I mean, there's no other way to describe it. Q1 earnings per share growth in the S&P, something like 27%.
Is that the biggest it's ever been, outside of maybe coming out of the pandemic or something like that?
Yeah, but that's the thing. Yeah, coming out of recessions, it does, obviously, when you've had really, really low earnings per share.
But this is after already the market, this is when the market's reasonably buoyant, it's put on 27%, you know?
Exactly. So, I mean, it's unlikely it's going to grow at that. The earnings are going to grow at that pace indefinitely. But I think one of the important things about, and I've shown this on a previous chart, is that when companies are earning, when their profits are growing at a rapid pace, they've got absolutely no need for headcount reductions.
Yeah.
And I've shown that previously that the pace of labour demand tends to keep track with profits growth. So we have this strong period of profits growth it should feed through into strong labour demand, and it does seem to be.
Are you telling us that the prices or the multiples that the stocks are trading on the US is justified with the earnings or not?
Well, I think you've got to be a bit careful. If we just look at chart 5, for example, and this is the semiconductor index, the Philly Semiconductor Index, the SOX, and you can see the projected earnings per share have gone vertical almost, as has the index. Now, it's had a setback in the last couple of days. But what I am saying is that the earnings forecasts, the 12-month forecasts, justify this rapid rise in prices. Now, what often happens is the prices turn down before the forecasts get updated.
Right.
So you've got to be a bit careful with this.
The forecasts are always lagging.
Yeah.
Yeah.
But the way things are at the moment, there's more demand for chips, all kinds of chips. This is not just the sort of high performance chips that NVIDIA makes. It's also memory chips, like bog standard random access memory chips as supplied by the likes of Samsung, for example. So there is this massive demand for all these kind of chips that is just insatiable at the moment, apparently insatiable.
It's quite something, isn't it, when you get that sort of vertical rise and it's justified by the forward EPS.
Yeah.
It's
but I think things have been getting a bit crazy, and if you look at chart 6, this shows
equity risk premium.
No. This is just chip stocks.
I've missed out a chart. All right, sorry, I've missed out a chart. Excuse me.
So these are some of the highest flying. I'm sorry, I said Western Digital, SK Hynix, and so on. Micron Technology. Just really an 11-fold increase or so, 12-fold increase in any stock in the space of a year. It starts to look a bit frothy.
It's got to take a breather. Nothing goes in a straight line forever. It can go in a straight line for a short period of time, but it has to take a breather. Whether or not it goes again, that's another thing.
And not only that, people have leveraged exposure to these things as well.
Oh, right, yeah. And that, I saw some of those ETFs got rubbed, like 2 years' work, get rubbed out in an afternoon.
Yes. There's 3 times geared Korean, I think it's MSCI Korea index.
40% down, wasn't it, on Friday?
I think it's halved in price in 2 days. But that's you've got to take the rough with the smooth when you
just explain to me a leveraged ETF. Just for...
Well, this particular one, and just to give an example, the ETF has to give 3 times the performance of the index. So if the underlying index goes up 1%, the ETF has to move 3%. But the problem is the manager of that ETF has to rebalance the ETF. So buys at day one, it's going to buy 3 times the notional.
You're going to be short of so much gamma on a daily basis.
Yeah, you are
especially on a big move. You're monstrous short of gamma.
If the underlying moves higher, you then have to buy more, and vice versa if the index drops. And so, 2 days of drops in the MSCI Korea, and
you rub out 2 years worth of work, or not 2 years. You rub out some of the action.
Yeah, I think the price halved. But anyway, so I think that's the bottom line with what's happened over the last couple of days, is that some of the froth has been blown off the equity market.
Is that how you see it? See, this is not a bear market. You don't think this is a bear market starting. This is perhaps something to look at some stage to buy into again, because the earnings are there to justify the multiples.
I'm not sure it's over, because I'm still a bit concerned about Treasuries.
Right. So let's briefly talk about Treasuries then. What's the yield on the 10-year at the moment? 4.50?
4.5 or so, 4.53 or something.
And what's the 30-year? Just over 5?
Yeah, 5-ish. Let's say.
All right. Is there like a line in the sand when they start making a real difference? Where do you see that?
That's a good question, actually. At some point, investors may prefer the steady, safe income from fixed income products, from treasuries.
Right, but you don't think that's yet, because clearly you're still short duration in your mind and on your trading.
Well, the point is that yes, I am. I think the way things are at the moment, I think investors don't want to be in cash products. It's been a losing strategy for the last few years. If you're just sticking your money into T-bills, earning, whatever they're yielding, 3.6% or whatever.
Missing out on 15% in the S&P.
Well, or even tips. I would prefer tips, where you're getting a 10-year tips now, which is a Treasury inflation protected security for anyone that doesn't know. So it pays you the CPI, whatever the CPI inflation is, plus the yield that it says on the tips. So yields, 10-year tips are now yielding 2.15 or 2.2%, I believe. So you're going to get a guaranteed 2.2% per year for the next 10 years, plus whatever inflation is.
Sounds like a good deal, but I must make this point. This is just Johnny's opinion. It is definitely not.
Absolutely, this is not investment advice. This is just my opinion. And if we look at, people do focus on equity risk premium, which in other words is a way of saying, are equities yielding enough in terms of earnings yield to justify the risk of an equity investment versus alternative fixed income investments?
Okay.
And if you look at,
chart 7, isn't it?
Yeah, chart 7. So the forward earnings yield on the S&P is roughly in line with the 10-year Treasury yield.
Right.
So in the past, there's been a much bigger spread. The earnings yield has been much higher on the S&P. In other words, it was valued much lower. PE ratios were much lower on the S&P, but the earnings weren't growing at the same pace.
Well, it comes back to my question to you. At what level is that 10-year Treasury in terms of yield going to really affect equities? I don't mean like a 2% move in one day.
Well, the answer is, I don't know. But what I do know is this. What I will say is this. You could look at this chart and you could say, well, there's not much of a spread between them and it used to be a lot wider. Well, that's very true. But you could have said that 3 years ago and missed out on a 70 or 80% rally in the S&P since then. So
the structure of equities has changed somewhat, isn't it? From boring stocks moving in a slow way to these explosive sectors.
Yeah, it's much higher growth. And so to some extent, it does justify a higher valuation on the equity market. The earnings are growing that much faster.
So you're telling us that the 10-year Treasury could move to maybe 5.5 and still be, equities would still be okay with it. But there's going to be a level, isn't there? Maybe
absolutely, there will be a level
when someone goes, hold on, I can get 6. I've got inflation at 3.5. I can get 6 on this. That's 2.5 guaranteed, 2.5 real. Do I want those equities?
I agree. That is the risk. So I look, the way I see things at the moment, I think we have. There's a good chance we have a bit more of a pullback in the equity market, and then maybe they can bounce back. But I'm more concerned about fixed income, and I think if we look at this chart 8, the last chart, and I've been saying this for a long time, that these thresholds, 4.5% on the 10-year and 5% on the 30-year, have capped yields for a long time. Really, These Treasury yields have struggled to break through those levels, and I think there is a meaningful risk that now, the way things are, they could break through.
Right.
And so I'm staying short of Treasuries, and from time to time, I tactically increase the exposure when I think the market hasn't really priced in some sort of upside risk. Like, for example, ahead of those payrolls, and I made it very clear in my note why I was doing it. And I think the next risk is the CPI. And then we have to face, Kevin Warsh's first meeting with the Fed next week.
So let me summarise. You think the Fed's going to change their bias away from easing? You don't see rates coming lower in the States. You think the equity market could have another drop downwards, but it's probably a buying opportunity for you based upon the fact that the earnings per share are justifying the cost of buying the equities or the valuations. Is that about right? Is that about where we are? And
Yeah.
you're still short of fixed. You're still short of fixed income, which I'm going to say once again is just your opinion and not an investment and not investment advice.
Yeah. I mean, the way things are at the moment now, the market has started to price in a hike by the end of this year,
Yeah.
a Fed hike by the end of this year. And I think that's possible. That is quite possible.
Over Trump's dead body. I didn't say that, by the way.
Trump will bitch and moan about it, but I think I don't think Warsh could possibly get the other Fed members to the FOMC members to agree to a cut the way things are at the moment. And I think, if anything, the bias is moving towards tightening policy now.
Just as the end is here, Jonny, tell us where people can read about what you're saying.
So, absolutely. So, my note is you can find at super-macro.com. That's the website. And basically, I write about the day's macroeconomics and finance and markets. And really, it's just a way for me to clarify my thoughts. It's not investment advice. You can do whatever you like with it. But I do a summary on the weekend where I explain in more detail. It's a summary of the week's macro data from the major regions. And I explain the thoughts behind the trades that I'm doing.
Thank you very much indeed, Jonny.
Thank you, Elvis.